Namaste, everyone. We're here to discuss relocating out of the US and how it relates to investment tax strategies. My name is Brian Kirby. I'm the lead advisor here at Alfonso Wealth. I have over 20 years experience in advisory. I began my career as a retail advisor with Merrill. I did that for a number of years before I moved to the institutional side, where I worked on mega corporate plans. I was one of the servicing managers in the Apple plan, as well as large government 457 and 403B nonprofit plans. I also have extensive experience in executive benefits and liability planning. Um, at Alfonso Wealth, we provide a comprehensive wealth management solution. We utilize a hybrid flat fee approach, more akin to a family office model. And we are a registered investment advisor. Our goal today is to share insights that have worked specifically for NRI tech professionals. Over 60% of our clients are of Indian origin, and we've implemented these strategies with hundreds of people, just like you guys today on the call. We work with this cross-border situation every single day. U.S. taxes, India ties, equity, comp, all of it. The two biggest roadblocks that we see are flexibility and liquidity. People worry about losing options, excessive taxations, or locking up money. We'll address that directly today. As part of our platform, we have CPAs and CAs on staff, so the US-India side of the equation is covered. We'll try and keep this practical, focusing on real-world applications. By the end of the webinar, you will walk out with actionable items for investment diversification and tax strategies, especially during the relocation planning stage. Joining us today as today's speaker is Rupesh Goyal. Rupesh has over 10 years experience in portfolio and hedge fund management, where he managed assets in excess of $300 million, consistently beating the benchmark. He has an MBA degree from the Carroll School at Boston College, is an active member of the CFA Boston community. Let's keep this session interactive. There's a Q&A button at the bottom to ask questions. We'll cover all your questions right after the presentation. Thank you for joining us today. Let's get started. Over to you, Rupesh.
Thanks a lot, Brian. So let's get started with a quick story of Aditya, who, after more than 10 years of hard work in the US, decides to move back. He's moving to his current employer, where he's worked Amazon's Bangalore office, and he's currently living in California with his wife and his daughter. His household income is around 500K, out of which 200K is through RSU listings. Now, the biggest challenges and the questions that he's facing right now is, what do I do with my RSUs? And how are they going to be taxed in the future? How do I avoid being taxed twice? How are my assets going to behave? And what assets I need to keep in the US versus in it move to India? And what do I do with my retirement funds? And how do I ensure my legacy plan remain intact? Any misstep here can cause Aditya to lose tens of thousands of dollars in potential fees, taxes, and fines. So what does he do from here? That leads to our agenda here. So we'll be going through a 3-pillar framework that he can use to protect his assets and save those tens of thousands in taxes. The first one, we go through tax management, where we would learn how to perfectly time the move and leverage the potential RNOR benefits. Just a quick idea what RNOR is. During the RNOR status in India, you are actually not taxed on any US related income, such as wages, capital gains, interests. Second, we will go through investment decisions, what to sell, what to hold, how and when to basically restructure all of his investments. And lastly, structural planning, how to air tighten his estate and legal setup so that the assets avoid any kind of probate and potential estate taxes. So now let's get to the first pillar, which is tax management. There in the center is this RNOR, which is called the golden window. So RNOR status is the most powerful lever actually you can have during your entire transition. When you return to India after living abroad, you are actually not taxed and you don't become a fully taxable resident in India. Instead, for up to 3 years, you qualify as this special status called RNOR. What happens during this period, during this time? Your foreign income is not taxed at all in India. Only the India sourced income is actually taxed, which could be capital gains or your salaries in India, which creates a very rare situation where you can actually realize all your foreign capital gains without any taxes. You can also restructure your assets before India starts taxing worldwide income. This RNOR status is not actually but automatic. It depends upon your past residency. So you typically qualify for it when you have been a non-resident for 9 out of the last 10 years, or you stayed in India for less than 730 days in last 7 years. Let's now take a look at the timing. How to perfectly time in your move, because even the month that you leave actually matters if obviously you have this under your control, which can thereafter affect your US taxes as well as your RNOR status. So this is where like a small decision can create very large outcomes. It also depends upon what your total income is expected in the US and what it's going to be like in India as well for you. So these things needs to be mapped out very, very thoroughly before executing this. So we have seen scenarios where just a 2 month shift can lead to $20,000 to $30,000 in difference. In Crux, it's not just a logistics move, actually, it's also becomes a strategy that you can implement to save this much money. Let's take an example. Aditya here timed his move to perfection by moving it in May. So that way, what he did was he used his deductions because he was still US resident for that particular year to reduce his taxes. And he was also able to reset the cost basis of all his stocks in January next year, because the Indian calendar years for taxes is April to March, and take benefit of the RNOR status. So by doing this, he reduced his taxes by more than $10,000, and he was able to book more than 150K in capital gain without any taxes. So what does the life look like after RNOR? So after RNOR, the system becomes less forgiving. So India taxes global income, including your interests, any capital gains that are happening on your US account. And there is no US tax withholding on those accounts. US will only withhold 25% of your income on the dividends that are being generated from your US brokerage account. But that is also contingent if you do proper documentation, because if you didn't do it, it can be 30% as well. In this case, credits help because you can still claim the foreign credits on the US taxes paid, but it doesn't eliminate, because if the bracket which you come under in US is in India is higher, you will eventually have to pay more taxes on your income there. And what happens to your retirement accounts? So they are then taxed at a 25% withholding rate if you use distributions in those accounts. And additionally, there is a possibility that you will have to pay 10% penalty on the early withdrawals on these accounts as well. And on top of that, there is a possibility that these accounts will be taxed in India as well if your taxable bracket is higher than what was withheld by US. Which is why all the major structuring should be front loaded into the RNOR status or before that, but not once the honeymoon period is over here with the taxes. So now let's move to the second pillar, which revolves around your investment management, and see how someone like Aditya needs to manage their investments more optimally. So the first one is RSU strategy. So RSUs in this case for Aditya is the biggest wealth driver, and it could become the biggest tax trap for him as well if he doesn't handle them effectively. So let's see what he needs to do before moving. So General rule of thumb, in order to avoid concentration risk for your portfolio, you should be selling the stocks at vest, because that makes you treat it as income, avoid any further gains and taxes on that, and it also avoids any concentration risk. So that's what he needs to do first. Second, he should also be avoiding selling stocks that has high capital gains already, because he can always pay tax, because he will have to pay taxes on them, and that's something he can avoid later. He may be looking to sell the stocks, and he should be, if his concentration risk in that stock is too big that that kind of keeps him awake in the nights. Let's say if the portfolio has more than 20% concentration of that individual stocks, then maybe it's worth it to sell those stocks. And lastly, there is this systematic investments called pooled funds, where you kind of invest your existing RSUs for diversification. That is something you should be staying away from, because they don't have any tax benefits associated once you kind of move to India. And given they have a lock-in period of like 7 years, it won't make sense for you to kind of put your money in there. Now, once he moves to India, he comes under this special status called the RNOR, and this is where the real fun begins. Now, what he needs to do here is sell the lots that had higher capital gains on his RSUs, either to diversify his investments, which he's been kind of looking to do, or reset the cost basis without any tax implications if he believes in the company and he still wants to keep his investments in that particular company. What he did was, here he will have zero tax liability on those huge capital gains which he just booked. And after RNOR, things get a bit inefficient, as he will be taxed at the Indian tax bracket rate on any of his capital gains and income that is generated outside. But he has already avoided major chunk of his taxes by resetting the cost basis and diversifying his investments. So the real strategy outline here is, it's for Aditya is not about should he hold Amazon stock or not, but it's about repositioning the exposure in a zero tax window instead of a fully taxable one. So next, let's take a look at how he needs to handle his other taxable investments. This is where sophisticated planning can actually create a very outsized value return. So pre-move, few things to kind of keep a note. Is the first one is to avoid any major realized gains, again, for the same reasons that you can do it later. Keep doing the aggressive tax loss harvesting to reduce your taxable income in the US, which can be done via tax loss harvesting or by direct indexing. And the third could be use hedging if you are not comfortable with holding a stock position that has outsized gains. That could be like covered call, any other option strategies which kind of covers your losses, but you don't need to kind of sell the stocks to kind of get out of the position or reduce your risk. During the RNOR period, what we can do is, obviously, first step is realize the gains that you've been holding on, effectively at zero India tax rate. Switch from direct indexing if you've been kind of doing to more on the ETF side, as cost bases are already reset, and you would want to probably have straightforward investments going forward, and there are like lower taxes on capital gains in India, so it may not be worth for you to kind of explore that particular opportunity. Also keep in mind that you should avoid US municipal bonds and treasuries, as there are no tax benefits associated with those investments, and they are a much higher return providing instruments available in the market during that time. And then finally, post RNOR, very similar. Every gain is taxed in India at the tax bracket rate. But if you've been strategic, you have already avoided most of the capital gains and diversified your investments. Okay, now let's look at real estate. How do you manage your rental properties and your existing home? This is where emotions and complexity collide. So before moving, if this is your primary home, Section 121 is a massive opportunity where you can no taxes on up to 250K of capital gains on that particular property. So basically, you can exit very tax efficiently and simplify your balance sheets by selling all those assets. Or you can keep the house and keep renting it out if you see there is a massive upside still there in terms of the capital gains and the rents coming out of it. During the RNOR period, if you still owns the place, the rental income can still be structured very efficiently under this treaty called Effectively Connected Income, ECI, where actually you report net income after all the expenses on the property rather than the gross income, which reduces your taxable income in the US. And even if you decide to sell during this particular period, this property, you can still use Section 121, but it comes with more complications and asterisks, basically. There's still no taxes on any of these income in India. And after RNOR, if you still have this property, you are potentially looking at dual taxation, currency issues, compliance, and taxes if eventually this property is sold at a later period. And based on our experience on working with several folks such as Aditya on these kinds of things, what we have known is this decision, it's not just financial, it's operational as well. Because here you are managing cross-border real estate or you are deploying it into simpler assets. In most cases, what we have seen, but in the end, is simplifying your assets before move or after your just after before your RNOR period ends. It creates more longer term flexibility unless you want to kind of move back to US at certain point in your life. Let's take a look at now at how to effectively manage your retirement accounts. So the first one is 401k or IRAs. They look very simple, but at cross-border, they are anything but that. So how do we strategize those? Before moving, we should keep contributing to the max, which is currently 24,500, the limit. But that's if your tax bracket is more than 30% at state and federal level combined. In addition to that, if there is also an employer match that's happening on your contribution, that would make sense for you to kind of keep on contributing to the max. What else you can do? You can also do a rollover during your low income years before your move so that you can create some more favorable tax situation. But that is something you would obviously have to look at it in terms of doing the calculations, whether your tax bracket is lower or higher in those income years. During your move, you're at your when you are under RNOR status. This is where the structuring would matter. First, you would need to do very appropriate kind of tax filings and structuring to defer taxes on unrealized gains on these accounts because the Indian government don't recognize these as retirement accounts and they can charge on unrealized gains or on your other retirement accounts. You can also leverage a substantially equal periodic payments, which is called SEPP plans, if you want to take out the money early without potential penalties and you want a consistent stream of income. After RNOR, withdrawals become less appealing with higher taxes and potential penalties. So withdrawals face 25% US withholding on the taxes, plus there could be Indian taxes also if your tax bracket is higher than 25%. So effectively, we are dealing here with layered taxation, obviously, if not planned properly. In Crux retirement accounts, it's not just about retirement here. They are also, to a certain extent, long-term tax liabilities that needs to be kind of sequenced in a proper manner across these countries. Staying with the retirements, Roth account is another account that we can discuss and strategize. This is where most people get surprised because Roth is supposed to be taxed because you have already paid taxes and you should never be taxed. But that's the case in the US, not in India, because again, India don't recognize these assets as tax advantage. So before the move, what you can do, you should immediately stop any new contributions in these Roth accounts, as it doesn't make sense for you to contribute to an account where you have already paid taxes, as it is post-tax money, and you're likely going to pay taxes on the gains in India, and there is a potential penalty you're looking at if you withdraw early. During the RNOR phase, if you already have assets in Roth, what you can do is you can liquidate those existing assets during your RNOR period and do a cost basis reset or kind of move it, in a different brokerage account. At this point, it's okay to pay 10% penalties on the earnings as well, if you want to kind of take out the money, because ultimately these will be taxed in India as well. And paying 10% penalty is lower than what you would eventually be paying in taxes in India, because the tax bracket can be as high as 20% for capital gains in India for you. So post RNOR, you will not be taxed on Roth withdrawals if there are only contributions, but you'll be taxed on the capital gains associated with this account. Let's take a look at HSA, how we can structure that. So HSA is one of the few instruments that is actually very powerful across borders if used correctly and efficiently. So before moving, similar things, you can max it out to the limit of, because it holds triple tax advantage with no federal taxes, no taxes on the gains, and no state taxes as well. During the RNOR period, you can withdraw the money tax-free with your either existing medical bills, or you can get yourself that money reimbursed from any past expenses without any kind of taxes or penalties associated with this particular account. But once your RNOR period ends, you can still use this balance for any future medical expenses in India without any penalties in the US, but it loses the tax advantage in India. So whatever money you take it out, it is actually treated as income in India for your taxes. So the play here is simple. You front load your contributions and drain strategically these assets before the India taxation kind of kicks in. So let's bind this all together and see how it worked for Aditya and how the execution looks like in general. So let's say Aditya has investments across ETFs and Amazon stock, and he's holding gains of over 150K currently on these assets. He has 401K, which is worth 200K. His HSA account is 20K, and his Roth investments are worth 50K in gains. So here is what he did. So he moved from 401K pre-tax money to 401K post-tax contributions in the year that is working with Amazon. Given this was the lowest possible income that year that he could have, he actually also front-loaded this 401K so that he gets the match from his employer as well. He didn't realize any capital gains on the RSUs and on the stocks before the move. And once he moved, what he did was he realized those 150K gains which he held during the RNOR status, which resulted straight away $35,000 in savings, which he would have eventually paid in taxes. He also used HSA for his previous tax bills to take out most of his HSA balance, and that saved him roughly $7,000 in taxes. And finally, he also had $50,000 of gains in Roth, where he took out the money by paying 10% penalties on their earnings, but he avoided roughly 20% of India taxes, which resulted in additional $5,000 in savings. So by just being aware of his investments and taxes, he was able to save roughly $50,000 in taxes and earnings. So let's take a look at the last aspect of his planning, which is about estate. So this is a defense mechanism to protect your assets and leave the legacy. The major goal of the estate planning is to avoid probate, which means faster and hassle-free transfer upon your contingency. It also avoids any freezing of the assets for financial institutions or from the governments, and it reduces the chances for you getting taxed on your estate and inheritance. It is especially tricky for retirements account where you can potentially face effective double taxation because there is estate tax and income tax associated with it. How to structure that? So there are three ways to kind of structure it. First one is direct beneficiary designation. So it's the simplest option. Just naming beneficiary on all your accounts to whosoever you like it. This is a clean, fast method where you avoid probate. Assets are transferred directly to your kids or your partner without any kind of court involvement. But there is a trade-off. You actually lose control. You cannot dictate when or how the money is used. It's just like a lump sum transfer. And there is another challenge that if there is a minor beneficiary included, when this transfer kind of happens, the money could potentially be freeze until they come of age. Also, the structure does not protect you from US estate taxes if you are a non-resident at the time of your, let's say, passing. The tax is calculated before the money reaches your beneficiary. So we are actually looking at a 40% tax before this money is kind of getting transferred. So it's simple, but very limited protection. So the second setup, which is the most favorable one, is the setup of revocable trust, could be a domestic. This is where planning becomes more strategic as well. A US domestic trust is easier to kind of manage. And what it does is it avoids probate, gives you control over your distributions, and simplifies your administrative work while you are in the US. In this case, all you need to do is have a trustee which is based out of US, and even if you are outside US and are non-resident, this would qualify as a domestic trust. If you don't have a trustee which is based out of US, it actually becomes a foreign entity. Then it becomes very tricky for you to manage because you are still looking at estate taxes and you are looking at very complicated filings such as Form 3520, 3520A, where the compliance cost can significantly go up for you. And the last setup is irrevocable trust. It is probably the most powerful, but it's also most rigid method of kind of setting up your estate. You are effectively removing your assets from your estate into this trust, which significantly reduces or even eliminates completely your estate tax exposure. It also protects assets from any kind of creditors or add multi-generation planning flexibility as well. But what you're doing is you're giving up the control because once the assets go in, they are not easy to kind of reverse it. So this is typically used when you have a very high conviction of who you want to pass assets to and what are the assets you are looking to kind of pass on to. And in conclusion, finding the right team who can set up the trust in a way that helps you protect the assets and create a domestic entity to avoid estate taxes on the passing of the assets is the key. So to summarize all, the first thing we learned is the timing is much bigger thing than actually investment returns here. We spend a lot of time chasing alpha, 1% or 2%, but if the cross-border planning is done correctly in a single timing decision, we can create more than 20 to 30% impact through just the taxes alone. So the biggest lever here is not the markets, it's the timing for a change. The second, the RNOR is the biggest opportunity for you. The RNOR window is the most powerful phase in this entire journey where you can realize global gains, restructure your portfolio without any potential tax impacts. The third, the cross-border planning is essential. You're not operating in one system. You're operating in two tax jurisdictions, which are often in conflict with each other. So without coordination, you can end up with double taxation, reporting issues, and suboptimal structures. So planning here needs to be fully integrated across the countries. And lastly, early planning is equal to maximum benefit. The best strategies such as Roth conversions, RSU planning, hedging, estate restructuring, or tax planning requires lead time before residency status changes. And if you wait after your move, many of these options either disappear or become far less effective. As famous financial coach John Obi-Wan Gandalf said, the difference between planning and not planning is not incremental, it's transformational. And with that, I would like to turn back things to Brian for our Q&A session.
Thanks again, Rupesh, for breaking that down. Now, we covered a lot of ground today, and due to time constraints, there are many topics we couldn't cover. Things like 529 versus Roth, having kids that are U.S. citizen, foreign exchange currency risk, and the power of LLCs. We know this is a lot to digest in one sitting, especially when you're balancing a full-time role. To make this actually useful for you, we put together a full slide deck from today and a recap video if you want to revisit a specific strategy. We will share this in an email after the call with a scheduling link. Each individual has specific needs, and we address that with a one-on-one approach. We tailor a customized solution to every client based on their situation. There is no one-size-fits-all solution. It requires in-depth planning based on the individual. When a client typically asks me, when should I start planning? My answer is always the same: yesterday. We've opened up a few one-on-one slots next week for NRI transition planning. It's going to be a screen share where we familiarize you with the Alfonso platform and gather specific information to your exact needs. We have a few questions that I'd like to answer. Starting with, if my RSUs vest after moving to India, are they U.S. taxed or India taxed, or both? Same company in the US and India.
Okay, so that's a classic case of cross-border complication. So the portion of the vest that corresponds to the time that you spent working in the US is actually considered the US source income. So the US, i.e. IRS, will take the portion of that regardless of where you live during that time. The rest of the portion, once you kind of moved in, and it's kind of with the Indian office, the portion would be kind of taxed as India as it relates to India income.
Okay. During the RNR period, am I filing taxes in both the US and India simultaneously? Who coordinates that? And what happens if the two filings conflict on something like capital gains treatment?
Yeah, generally you would need to file taxes both to get the maximum benefit out of it. So it's a very key question, because if things work in isolation, then this is a very classic problem that most people would face, that because there is difference in the calendar years as well, because US would be using January to December and India would be April to March. So it creates a lot of conflicts and challenges around what to include, what not to include. That's where you would need someone who can integrate your US and India taxes more efficiently. Ideally, your India tax statement should be speaking to US tax statement and vice versa, so that there is perfect coordination and you are not putting assets in both the places and is taking the most out of it during your, let's say, R&R status, where you should not be kind of getting taxed in India.
Okay. What if the move has 60 days to plan only? What is the minimum time to get it done?
Okay, so if you have 60 days, I mean, the planning aspect, with the planning aspect, the most important things then that needs to be done is your estate planning. You should be kind of setting it up, your estate plan. In terms of capital gains, obviously, you don't need to do anything around that. Just make sure you don't sell anything, or if you are looking to sell something, make sure you are kind of hedging it rather than booking any capital gains. And then obviously some kind of legal paperwork that you need to prepare and set it up, like W-8 filing, so that any taxes that are withheld in the US, they are not taxed at higher tax rate and are based on the US-India tax treaty. So those are the kind of key things that you should be kind of looking at in just last few days before you kind of move.
Okay. Do my US born kids get 529 and other benefits?
Yeah, I mean, they do. If you have a 529, it is kind of a challenge in its own because when you have the 529, it's kind of a favorable treatment in the US whether when there is no taxes on the gains that you have, but India doesn't recognize it. So it becomes a taxable account in India, but it's still a tax advantage account in the US. So it's kind of again a classic problem of how to kind of optimize through it. So that can be done either through, let's say, beneficiary change, ownership change, through trust setup, so that you don't pay any taxes to that, and your kids can use full potential of that money once they go to college.
Great. Should I sell US property when in US or in India as an RNOR?
Well, it can be done both. Ideally, you should sell it before you move to India so that there is no additional paperwork. But during the RNOR start, you can still sell them. You can still have that Section 121 where you kind of don't pay any capital gains in the US on that 250K addition of capital gains which you incurred. So, yeah, I mean, but don't try to sell it before your RNOR period ends because after that, you're gonna get taxed in India as well.
Okay, so question, what did Aditya do for 401k?
So for 1K, yeah. So what he did was for his contributions, what he did was given his income was much lower in terms of the tax bracket. So he actually did a Roth contribution through his employer rather than 401K pre-tax. So it's 401K post-tax. So he still got the match and he was still able to contribute to his 401K. It's just that it was post-tax. And if, let's say, I mean, not just Aditya, but in case, let's say, if you are planning early and you still have some time, so you can do a rollovers from your 401k to your Roth in low income years so that you are kind of, not freezing those assets and potentially getting double taxed or kind of taxed higher on those 401k assets.
Okay, if I move out of the US, then back to the US after a few years, does the RNOR period restart again?
It depends on what's the period we are looking at. So how it works is, so let's say if you were in US for the last 10 years and now you move to India, so you wanna probably take the tax benefit for 2 to 3 years in the US, in India, sorry. So now let's say after 3 years, if you move back to US, then you can still take the benefit of RNR status as long as for the next 6 to 7 years, you again stay in the US and then come back. So basically, the period resets when you kind of move back to US for RNR status to kind of get structured or qualified. So it's very much a possibility that you can again be an RNR. It's just that you still have to live again, let's say 7 years, 8 years in US and then come back to India to get the benefit out of it.
Okay, now how do these things change if I am on a green card?
Then it becomes very different because with green card, you can still get the RNOR. The citizens won't get the green card. You can still get the RNOR, but then once you have the green card, the US government claims every taxable event for you. So necessarily what is happening is if you book any capital gains, while you may not be taxed in India, you will still be taxed in US because you are a green card holder. So it may not be applicable completely for someone who has a green card because they won't be able to take benefit of cost basis reset because they would still eventually pay in US. They would avoid in India, but they would pay in US. And again, it will be based on what their final tax bracket is for that kind of payments.
During the RNOR, the RSUs that were allocated in the US but vested in India, am I exempt from the US tax on the RSU?
If your office location has been moved to India, yes, you would be kind of avoiding those taxes in the US, but it would still count as India income, so you would still be paying taxes on it, although it would be through India. So, I mean, in general, these things are very, very complicated. But if you work in a company where these things are kind of handled effectively. So you would necessarily see here two documents kind of issued, a W-2 and a Form 16, which is in India. So you would be probably easily separating those things out, how much of that is kind of taxed in US and how much you need to pay taxes there versus what's going to be in India.
Great, thanks. Rupesh, thanks again for answering all those questions. I just want to reiterate that we are sending out this slide deck for you guys, and we are opening up slots for next week and actually the following week as well. So if you want, jump on, book an appointment. We'd love to do a one-on-one with you. Besides that, I want to thank everyone for their time and the great questions. We look forward to continuing the conversation, and have a great weekend, everybody.
Thank you.
Bye, guys.